Today the topic for discussion is the second part of insurance. That is the concept of life insurance. In this video we are going to discuss about the concept of life insurance and what are the different types of life insurance schemes. Then what are the advantages of life insurance? Then the concept of reinsurance and double insurance. Let us see, a life insurance policy is a contract with an insurance company. It is actually a contract with an insurance company. So it is an agreement between the insurance company and the policy holder. In exchange for premium payment, the insurance company provides a lump sum payment. It's known as death benefit to the beneficiaries upon the insured's death. Life insurance is defined as a contract between the policy holder and the insurance company. It is a contract between the two parties, and that is the policy holder and the insurance company, where the life insurance company pays a specific sum to the insured's family upon his death. There will be a situation of death. The insurance company pays certain amount of to that particular insured's family members. The life insurance sum is paid in exchange for the specific amount of premium. Life is beautiful, but it is also uncertain. Whatever you do, however smart and hard you work, you are never sure that life has in store for you. In this context, the importance of life insurance exists. The definition part of life insurance is a contract whereby a person called insurer agrees for a consideration, that is the payment for a sum of money, or it is paid in periodical payment as installments, and it is called premium to pay to another insured his estates. The stated sum of money on happening of an event depend on human life. So this is a situation of life insurance. It will be an insurer and insuring certain amount to an insurance company that is payable. When something is happened for that particular person, the insurance company will pay the amount of claim. Life insurance is a contract to pay a certain sum of money on the death of a person in consideration of the due payment of a certain annuity for his life calculated according to probable duration of life. These are some of the features of life insurance. And life insurance, it is a contract relating to the life of human being, and need not be express provision that the payment is due on death of the person, and the contract provide for payment of lump sum money. The amount is paid at the expiration of certain period or death of the person. So this is the way the amount that is paid at the expiration of certain period or on the death of the person. So this is a situation of repayment of the policy amount. The first essential for working of life insurance is calculation of risk to fix the amount of contribution, that is called premium, to be made by each policy holder according to certain parameters like age, medical history, his habit, occupation, etc., so that the fund should be adequate to meet the whole claims. So the taking a policy is based on certain parameters like his age, education, his habits, occupation, etc. So based on which he is taking the policy, and it is a contract. Actually, life insurance is a contract between the two parties, the insurer and the insured. An insurance contract is a document representing the agreement between the insurance company and the insured. So central to any insurance contract, the insuring agreement which specifies the risk that are covered, the limit of the policy, and the term of the policy. These are three important things that will be there in an insurance contract. First one, the risk that is covered, and second one is the limit of the policy, and the third one is the term of the policy, that is called the duration of the life insurance policy. In addition to that, there are certain things that is like the conditions, that is which are the requirements for that particular policy, that is called the conditions. Then second one is the paying the premium or a reporting of loss. What are the conditions that you have to do? And another criteria is the limitations, which specify the limit of the policy, the maximum amount of that he has to pay during the time of claim. So that will be also going to discuss in this particular situation. Then the same time going to discuss about the exclusion of certain things, that is it is not covered under the situation of a life insurance policy. So that is also there in the policy situation. One is what are the conditions, and second one that is regarding the limitations of the policy. So that is regarding the maximum amount and a minimum amount of the policy, and what are the exclusion of the policy situation. That means there are something which is not covered in the policy, that is called exclusions. And in addition to that, there are certain requirements for a valid contract as per the Contract Act, and the first one is there should be an offer and acceptance between the two parties. So there will be an offer from the part of the insurance company, and the offer is accepted by the policy holder or the person who is going to take the insurance policy. For accepting that one, he has to pay certain amount as consideration. That is the second thing. And in the same time, the insurance company will measure the competency of the person who is taking that particular policy. The competency of the parties for taking the policy, and the legal purpose or the legal validity of the contract is also going to measure in cases of taking an insurance policy. And at the same time, the nature of contract as compared to the general contract situation, there are some specific characteristics for the contract of life insurance, and it is actually a type of unilateral contract. It is a type of contract where only one party to contract make legally enforceable promise. It is actually a unilateral contract because only one party to the contract makes legally enforceable promise. Here it is the insurer who makes an enforceable promise. There will be a from the part of insurer, he is enforceable that particular promise of a contract. And the second one is the contract of utmost good faith. An insurance contract is a contract of utmost good faith, and therefore the contracting parties are placed under special duty towards each other, not merely to refrain from active misrepresentation, but to make full disclosure of all the material facts within their knowledge. So that is the most important thing. He disclosed all the material facts regarding his health conditions, his family background, who are the beneficiaries, is there any pre-existing disease or not. All these things have to be mentioned while taking the policy. So this is the importance of utmost good faith. And the third one is a conditional contract. It is actually, life insurance is a subject to the conditions and privilege provided on the back of the policy. So there are certain conditions and privileges will be there. It should be noted on the back of the policy. The conditions put the obligation on the party to fulfill certain conditions before the proof of death, of disability, or the disability are the part of the particular contract. The conditions, whether precedent or subsequent of the legal right, must be fulfilled in order to complete the contract. So that is also the third important thing. It is a conditional contract because there will be terms and conditions regarding that particular policy will be mentioned here. And the next one, it is an aleatory contract. In such kind of contract, no mutual exchange of equal monetary value is done. It is the happening of the contingency on which the payment is made. If death occurs after payment of a few premiums, full policy amount is paid. So that is why it is called a aleatory contract. And the next one, it is a contract of adhesion. In such contract, the term of contract are not arrived by mutual negotiations. It is not arrived by mutual negotiation. Similarly, in life insurance contract, the contract is decided upon the insurer only. So the insurer is deciding that particular contract. The party on the other side has to choose between two options. They can either accept it or reject that particular policy. And the next one is a contract of a certain amount. So actually, life insurance is a contract, does not provide an indemnity. It is in the nature of contingency contract by providing for the payment of the agreed amount on the happening of the event. So it is a type of contract of certain amount, that is amount payment. There will be a certain contract for paying certain amount. It does not provide any guarantee because life insurance company is not providing any guarantee for the life of any person. So something is happened for the person, company will compensate that financial stability of the family members. That only the guarantee that is given by the part of life insurance company. And the next one, it is a standard form of contract. In life insurance, all the essentials of in general contract as provided by Indian Contract Act 1872 for a valid contract, that will be there in cases of a life insurance policy. So based on Indian Contract Act, what are the essential conditions will be there? All the essential conditions of a valid contract that will be applicable for a life insurance contract. So how to form a life insurance contract? So there will be the offer and acceptance. The intimation of the proposer's intention to buy the insurance policy is called the offer, while the insurer's willingness to undertake the risk, it is called acceptance. So in all the general contract, the first one there will be offer and acceptance. So the proposer's intention to buy the insurance policy is the offer, and willingness to undertake the risk is called acceptance. Second one is the consideration. The law of life insurance is also requires a lawful consideration for its validity, as it is essential to legal contract. So it is a legal contract of consideration. Consideration is the price for which the promise of the insurer is purchased. It is the price for which the promise of the insurer purchased. And the next one is the competency of the parties. The parties must be competent to enter into a contract. The parties must be of the age of majority, of sound mind, and not disqualified from contracting by any law to which any of them is subject. So there is a contract of the age of majority, and there will be sound mind from the part of that particular person entering into the contract, and there is any other type of disqualifying part for entering into the contract. So that is also measure while entering into a life insurance contract. So in that case, the competency of the parties are most important. Then the another one is the legality of object. A contract will be invalid if the object is illegal or against the public policy. Normally, once you are entering into a contract, that validity of the contract depends upon its legality or the legal provisions. So the object is illegal or against the policy situation, normally the contract will be disqualified. The object of life insurance contract will be legal if it is made for one's own protection or for the protection of the family against the financial loss due to the death of that particular person. So the legality of the contract in this case, it is important. And another one is the free consent of the parties. When parties to a contract agree on the terms and conditions of the contract in the same sense and spirit. So both the parties, both the insurance company and the policy holder will have the same mind, they understood the terms and conditions clearly. So agree the terms and conditions very clearly in the same sense and spirit. They are said to have free consent. So if such situation is there, it is said to have free consent. The consent is said to be free when it is not caused by coercion, undue influence, or fraud, or misrepresentation, or mistake. So a consent is said to be free. So once you are giving a consent is free, it is not caused by coercion, it is not caused by undue influence, it is not due to fraud, it is not due to misrepresentation, and there is no mistake from the part of the parties. And in the contract of insurance, the insurer and the insured must be in genuine agreement as the subject matter of insurance. That is, life to be insured, sum assured, and terms of insurance, and every other particular relating to the contract. When a person signs a proposal for insurance, he gives his free consent to the contract. Actually, it is giving the free consent to entering into the contract. Let us see the performance of a life insurance contract. The performance of a life insurance contract has discussed in the following two important headings. One is preparation of the policy and second one is the conditions of the policy. So policy preparation. In policy preparation, the policy is prepared after formation of the contract. The preparation of policy involves various stages which are of prospectus, filling up of proposal form, construction of policies and alteration of the policies. All these will be there in the part of preparation of the policy. The policy holder has to go through all these things like the prospectus, how to fill up the that is application form, then how to construct that particular policies, and if some alteration have to be made, how can we make some alteration for the particular policy. And second one is the condition of the policy. Conditions of life insurance contract are generally governed by the conditions and privileges mentioned on the back of policies. So conditions that will be mentioned on the back of the policy that you are taken. Since there are different kinds of policies, the conditions and the privileges will be different from policy to policy. So once you are taking one policy, the terms and conditions will be one type, and if you take another policy, the terms and conditions will be in another way. And some of the conditions of a standard policy, there are certain things that will be there in a standard policies are the proof of age, then the certain future events that is going to happen, then the duration of the policy, how many years that you are taking the policy, then if there is some days of grace or something like is there, then regarding the premium notice, then regarding the payment of premium, then during the time of maturity, how will you get that premium amount, that is called returning the premium amount. Then if there is something is happened for a default on payment of policy, how can we go for revival of lapsed policies. So all these things will be there in the condition part of a standard policy. Let us see what are the different kinds of life insurance. Life insurance products are usually referred to as plans of insurance. These plans have two basic elements. One is death cover and other is survival benefit. So two types of benefits are there. One is the death cover and another one is the survival benefit. If regular premiums are paid throughout the duration, one gets the sum assured in the policy at the end of the period. So if he is regularly paying the premium throughout the time period, normally at the end of the time period he will get the policy amount. If the policy holder dies while the policy is in force, his survivors will get the amount as compensation for the economic loss. So there is something is going to happen for the policy holder, the amount will be get as a compensation for the economic loss. Let us see some of the major kinds of insurance plans, and the first one is a term insurance. The plan of insurance that provide only death cover for a specific term is called term insurance, and you can select the term for you would like the coverage up to 35 years. The payments are fixed and do not increase during your term period. In case of untimely death, your dependents will receive the benefit amount specified in the particular policy. So that is in the case of term insurance. And in case of pure endowment policies, the plan of insurance that provide only survival benefit, so that is called a pure endowment plan. The term insurance plan is just the opposite of term insurance that is plan. It is totally different from term insurance plan, is just opposite from endowment plan actually. In this plan, the life insurance company promised to pay the life insured a specific amount only if he survives in the term of the plan. If the insured dies during the tenure of the plan, then the family is not entitled to anything. It means that there is no death cover. But in this plan, the premium is much higher compared to term insurance. So that is the importance of a pure endowment plan. It is different from the first one, term insurance. And the next one is the annuity plan. So annuity pension plan are practically same as pensions. We all know that each and every person is going to retire at some time or other, and the great risk after retirement is that lack of income or reduced earning capacity. To take care of this, different insurance companies have providing different types of plans in the form of annuity. A contract providing for regular periodic payment during a specified period is known as an annuity contract. And the fourth one is the unit linked insurance plan or ULIP. These are the market linked insurance product that provides a combination of life cover and wealth creation options. This is a very attractive and equally useful scheme. Hence, after paying the first 2 to 3 years premium, even if one does not pay the rest of the premium, the insurance protection will continue in this case. The policy does not lapse. Most importantly, it provides flexibility of choosing from various variety of fund options depending upon the circumstances of the risk situation and how the customers are able to take the risk of his policy. Under the unit linked insurance plan, the holder can decide whether to invest in equity shares or debt or company deposit or only in government schemes or in money market operations. This scheme will certainly provides all type of persuasive in insurance sector in future. So it is a type of protection, as well as you can select the option of both the levered and unlevered market situation. You can select the levered situation or unlevered situation. So that is depending upon the preference of the that is policy holder, the investment have to be made. And the fifth one is the whole life policy. The term insurance plan with the specified period is called whole life policy. Under this plan, premium are paid throughout the life till the death, but the claim, that is the sum assured, become payable only after his death. So that is the importance of the whole life policy. Then the next one is the limited payment whole life policy or whole life policy with a limited payment. Here the policy holder can decide the advance, the number of years he is going to pay the premium. After the period of premium payment, the risk continues without payment of premium, and if the policy is participatory, the amount of yearly declared bonus is added to the sum assured. And the seventh one is the convertible term insurance policy. It is a term insurance policy with a period of 5 to 7 years, and they have to decide whether they can convert into whole life policy or endowment policy. There is an option for conversion. It is 2 years before the end of this particular policy. So there is an option of conversion of this term policy into whole life policy or endowment policy. For this, there is no need for a fresh medical examination. Only premium has to be paid at the time of making the changes according to the changed age and for the changed term accordingly. So there is no need for going any further medical examination. He can just convert his term insurance policy to whole life policy or endowment policy. Let us see some of the advantages of life insurance. So based on our discussions, and the first one is it covers the risk of death. It gives financial assistance for the family members if something is like premature death or something like is going to happen. And another one is it encourages compulsory saving habit, and it facilitates the liquidity situations, and it is a source of investment also. Then it provides assistance in odd situation, and it facilitates loan facilities. You can pledge insurance policy into banks and financial institutions for getting the loans. Then at the same time, the policy holder can claim tax relief under section 80C of Income Tax Act, and it is a type of mental peace also. So these are some of the advantages of taking an insurance policy. So let us see the two important concepts of insurance, and the first one is called reinsurance. Reinsurance is a contract between two or more insurance companies by which a portion of risk of loss is transferred to another insurance company. It is called a reinsurer. So there will be a portion of risk factor is transferring to another insurance company, and that is called a reinsurer. Usually an insurance company insures a profitability venture that comes in its way even if the risk involved is beyond the capacity. So, but if at the particular stage it feels that the risk is undertaken by it is beyond its capacity, then it may retain the risk which he can bear and transfer the balance. So that option will be there in case of reinsurance. By transferring the risk to another insurance company, the insurer reduces his liability. The existing insurance company can reduce his liability. In case of loan, the first insurance company gets compensation from the second insurance company. That is another benefit of reinsurance. The insurer is covered. It is concerned only with the first company. He consulted only with the first company from which it purchased the policy, and it is not the part of the reinsurance contract. So he can meet the first insurance company. So first insurance company transferring a portion of risk to the second insurance company. If something is happened, the insurer can contact the first insurance company for getting the amount of claim. Some of the features of a reinsurance contract are: it is a contract between two insurance companies. In reinsurance, the insurer transfer the risk beyond the limit of his capacity to another insurance company. He transferring the risk factor to another insurance company. The relationship of assured remains with the original insurer company only. The reinsurer is not liable directly towards the assured person. And reinsurance is a contract of indemnity. And reinsurance does not affect the right of the insured. That is also another advantage. And the fundamental principle of reinsurance are applicable in normal insurance. Fundamental principles are applicable in cases of reinsurance also. The fundamental or the basic principles of all the general contract or other laws applicable to the existing insurance is applicable in cases of reinsurance also. The original insurer does not reinsure more than the insured sum. So he can go for reinsure only with the specific limit of that particular insured amount. And another term is double insurance. Double insurance refers to the method of getting insurance of some subject matter with more than one insurer, or with the same insurer under different policies. So it is the method of getting insurance of some subject matter with more than one insurer, or with the same insurer under different policies. This means that a person may get two or more policies on the same subject matter and can claim the amount of all these policies. So that is the advantages of a double insurance policy. So some of the features of double insurance are: more than one policy can be obtained against the same subject matter or the life. All the policies related to the same subject matter. The risk covered in all the policy is the same. The risk in the policy is of the same period. The insured has equal insurable interest in the subject matter. The policies can be obtained either from the same insurer or from different insurers. And double insurance is beneficial in life insurance only. So that is the another characteristics of double insurance. So these are the topics that will be discussed in our video. In this video we discussed about the concept of life insurance and life insurance contract, and advantages of life insurance, then different types of policies of life insurance, reinsurance and double insurance. Thank you all for watching this video, and see you in the next video.